right, how are you? Sorry, it's very, very loud in here. Please answer the poll. You comfortable? All right, might as well get going. Good morning. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance, because trading is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Guten Morgen, my name is Wayne. I like money. Yeah, this is what a capitalist pig dog looks like. Yeah, I like money. Money doesn't make you happy, but it does solve a lot of problems. Right? Try making a massive difference without having any access to resources. Money gives you access to resources. Anyways, whatever. I'm a capitalist big dog. I can't help it. But what does that mean? I have a long-term vision. I like investing. I like trading. I combine macroeconomics with how you say, market sentiment and timing. So I like the market. Okay, I like the markets. Markets tend to solve problems. The markets are usually correct. As an aggregate, we make decisions. The markets. And what that is a bunch of people thinking about the future, thinking about current conditions, and allocating resources or protecting resources appropriately. Very cool. I mean, it's very interesting. So like this week, we got a lot going on. And, right now the markets are sort of in hesitation mode. Yeah, well, it makes sense because we're worried about the near future. We're worried about what the Fed's going to do next week, so on and so forth. Yeah. Which reminds me, I think I just accidentally scheduled a Fed meeting on the wrong week, so I have to change the schedule on the YouTube channel. But anyway, so nice to have you here. I need you to participate. I need you to tell me what you need from me because I'm not a mind reader. So let me know how I can help. I am here to serve. I am your servant. By the way, my name is Wayne. I've been doing Forex on YouTube since the day it became available. In fact, Google didn't even own it yet, which was interesting. Yeah. And before that, I did private, I guess you'd call them streams. Back then, what I did is I used, I think even a webinar was kind of a new term, but I used online voice over IP software that allowed you to share your desktop, which was radically new back then. Radically new. And I used that to show people how I taught myself how to trade Forex. Very cool. So anyways, I've been doing this a long time. 20 years, bro. Sharing. So let me know what you need. The resources have also probably already been created for you. For example, let's say you're like, Wayne, I just want to learn on demand. I just want to watch some videos. Do you have any videos on how to trade? How about 100 hours of videos? And lecture style training. lecture style, not just me babbling like I do every day. Hey, Marina. Yeah, good to have you. We always have a chair for you. So thank you for being here. So everything from technical analysis, trading basics, price action, how to use your platform. I guess we're going to need one on TradingView soon, huh? Central banking, you got to take this course. You have to. Macroeconomics, you have to take this course, right? And then do the day trading and swing trading courses. Like here's swing trading, here's day trading. Do those later. One of my favorites of all time is this oil investing course. Just absolutely epically cool stuff. It's $88. Has it been that long already, Marina? I'm surprised by that. Yeah. Not your loyalty, but just that it's been 10 years. Yeah, I got to get back to South Africa, huh? I guess, how about this winter? Maybe I got to find a reason to get to South Africa this winter when it's winter here and summer there. Yeah, I should do that. Yeah, maybe I'll put it as a goal. I'll strut the beaches of Cape Town and I'll have six-pack abs by then. Wouldn't that be neat? Or at least a three-pack. Anyway, so I'm working on that stuff. Anyways, cool. Look, guys, I'll teach you how to trade properly for $88. Okay. No, in my winter, your summer. Yeah. That would be cool. All right. Okay. So I'm trying to create like a value ladder. This is what I'm kind of doing right here. I want to show you like you start. Let's do this. Okay. Where do you start in our relationship, right? Investor Bootcamp, IBC. Okay. And then you go in Investor Bootcamp, you go to one of the live groups. We have two live groups. We have two live crews. Okay, day trading and swing trading. And it helps you apply the lessons here to the live market, and you learn a lot of it is trader psychology and how and when to plan certain things. But that's the next step. The third step is you need to know fundamentals, and that comes from QuantBox, and I'll show you that in a second. Okay? Because fundamentals help you understand why the market's moving. Trading here technically simply helps you use scientific methodology to measure how it's moving, but it doesn't tell you why. Then you go, okay, once you learn how to do fundamentals, you go up the value chain, and that's what this guy is doing. He's going up the value chain. And now we have something called TRADARS. I don't have an acronym for it. It's TRADARS. And now what it's doing is it's doing this work for you. An assistant. And you're at the next level here where you have a quantitative analyst working on your trading desk, and you have a technical analyst working for you on your trading desk, and you're making all the decisions. So this is the next thing I'm trying to do for us. And I emphasize us because the reason I'm doing this is I want to continue our relationship with you even if you become a success, or especially after you become a success. And I want to add something new here. And I haven't announced anything, but I like the idea of getting you propped. So wouldn't it be cool if I teach you how to trade properly, and then you join the live groups and you learn how to execute what you've learned? Then you add a quantitative analyst to your methodology. Then you add a technical an analyst doing all the grunt work so you don't have to spend 12 hours a day in front of your charts. And then I get you your first $100,000 account. Yeah, well, Abdul, I was there. It's a nice town. I had a good time. Been there, man. Been there, done that. Done and dusted. I think we had 300 people in the room. So anyways, what do you think of that? Where one day you are part of a community of, let's say, 50 people, 50 traders just like you, and they're using TRADARS, they're using QuantBox, they have live coaching, and it's all under one banner, plus you have $100,000 first, right? The idea is after you get your first 100,000, let's say by the end of the first year, you have like 500,000 under your wing. Oh my God. I can help you build your entire trading desk, you know? So anyways, that's how I envision all of this. So anyway, so here's QuantBox. Okay. You should try it. It's not very expensive. There's a trial. Okay. So on and so forth. Cool. I posted today's video and it's here. So if you want to see today's video, delayed of course, because I already did this a couple hours ago, I think, right? If you want to watch this video, subscribe here. How should you buy or sell CAD? How to decide with quantitative analysis and scientific methodology. Period. That's what's up for today, served hot and fresh. TRADARS is absolutely astronomically amazing. So if you want a technical analyst working for you that creates trade plans like this, hey, look, daily up. Triangle breakout, probably going to go up. If you want a technical analyst that works for you 24 hours a day, 7 days a week, and never makes a mistake, watching 7,500 charts in real time, and alerts you to the handful of things you should focus on today. Not even today, now. It updates in real time. You need to try this. And I'm not ready to make an announcement today, but maybe as soon as this week, I am hopefully going to be able to be in a position to make an announcement that for those that are in the Plus program, there's a massive upgrade going to be made available to you. A massive upgrade, and it's huge. You're going to be amazed. I know it sounds like a sales pitch, doesn't it? You will be amazed at the wonderful. Like I should be a circus announcer, right? And now, center stage, I present to you the amazing upgrade. Maybe by Wednesday I'll tell you what it is. Huh? Yeah. Okay. Yeah. No, I can't give you a hint. But you want to be around for that. There's some other things we're also working on, and that's the other thing. I'm trying to figure out in what order and how will I actually tell you about all these things I've been doing for you. But just think of it this way. While you're away, meaning from webinar to webinar, I care about you. Again, sounds like a sales pitch, sounds like BS. But I spend my time and my evenings and my weekends planning on how to help you. And so I got some big announcements in several different places that you didn't even ask for, but I'm going to give you. I hope that's okay. And it requires real money, but you will get these things. It just comes out of, your investment. I take that and I reinvest it back into you. Cool. So anyways, that's coming. That's coming. So now you have technical analysis. Okay. Now you have technical analysis and fundamental analysis, right? And by the way, there is a YouTube channel I wanted to show you. If you just again, you don't quite get it. You're like, TRADARS is interesting, but I don't quite get it. There's some silly little videos. And it allows you to look at it with funky music. Indices with funky music, and you can skip ahead. Whoa, funky music. Right? Anyway, so you can actually see what it looks like. I hope you don't mind. So it's not amazing content, but if you just want to see it, you're like, Wayne, I just want to see it. Well, there you can go. Or the other way, if you just want to see it, do the email subscription and you get an email every day. Yeah, cool. Now, with all of this said, you're going to need a good broker. And I honestly believe you're going to need an ECN. That's that. Okay, with all these resources, the next, if not final, I guess you should do it sooner than later, but you need an ECN to clear your trades on your trading desk. So I want you to look at everything that I'm doing for you is to help you become, if not a professional trader, trade like you're a professional trader. Like bring some professionalism to your trading. And so in the tools that you have, in the processes that you have, but also the service providers that you have. Okay? And in this case, you need a trading partner to clear your trades. I want you to act like you have a trading desk. And you need a liquidity partner, right? Well, most brokers just, I don't know. Your trades never enter the interbanking system. They just match your trades with other people in their system, and if that doesn't work, then they'll take the other side of the trade, because the whole idea is that if 90% of retail Forex traders end up blowing up their trading accounts over time, then why would you actually execute the trades? Why wouldn't you just keep them like a casino? The longer the casino keeps you in the casino and gambling, the more likely you're going to lose all your money, right? So a casino will do whatever it takes to keep you gambling. They'll say, stay here, we'll give you free drinks or cheap drinks. If you gamble enough, we'll give you a free steak dinner. If you gamble even more, we'll give you a free hotel room, but please stay here, because they assume and even sort of bet that you'll lose everything. That's not what an ECN does. They provide a service. They actually put your trades into a pool of liquidity partners, and the trader on the other side of your trade won't necessarily be like another retail trader, like at a bucket shop, but in this case, Goldman Sachs might be on the other side. So anyways, all these resources, learning how to trade, adding fundamentals, automating your technical analysis so you have more time to spend on decision-making process than burning through chart after chart after chart looking for what to do. And then a proper trading partner to clear your trades for you. You'll have the complete package. Alejandro says, If we are bullish because of earnings, yeah, that could be one. Yeah. And we want to buy Aussie dollar and short, yeah. Well, that's going to be difficult, Alex, right? So you're like you have a mixed bag with that type of trade, right? And so maybe one is hedging the other. I'm not sure why you'd want to do that. But yeah, if you're risk on, it's very quantitative for me to answer that. So if you're risk on, let me just show you how easy this is. Again, you just have to have the proper tool. So this is like a retail Forex trader's Bloomberg terminal. Now, professionals have Bloomberg, and it costs them somewhere between $1,000 and $2,000 a month. This is a retail Forex trader's Bloomberg terminal, but it's $80 a month. So how do you make a decision whether risk on or risk off? Because that's what I asked. And let's see the poll. Okay, thank you for your votes. I appreciate that, everybody. So I'll end that here. Okay, so we go here. And right now, the market is undecided today. The market is undecided this week, although it was risk off Thursday of last week. Now it's not. On a monthly basis, it's still risk off. Okay? But Alex is basically saying, what do I do if I'm bullish? Well, first of all, in the long term, the market is not bullish. In the short term, the market is neutral. But you're saying, well, today it'll turn bullish. Okay. Well, if you're a bull, well, let's look at what you do if you're a bear. Okay? So if you're a bear, the typical standard operating procedure is to buy these things. Okay? So if it's risk off, you're bullish dollar, yen, and Swissy. Now we have three different central banks here, which represent the global reserve currency, the European reserve currency, and the Asian reserve currency, although yen is very quickly losing that status. So now we have to say, well, this is normal. Do we have those market conditions? Well, dollar, I would say, yeah, okay. I would be, if we're risk off, I would want to buy dollar. Yeah, I'm okay with that right now. But Alejandro says, hey, well, what do I do if I'm risk on? And you're going to focus short term. Well, the first thing to realize is if you're risk on, this is probably sell dollar. But also realize that then we have a breakdown of fundamental congruency. You'd be short-term long, but still long-term short. So you're going to have some choppiness in that. And because of that, Alex, I'd want you to be sensitive to, what's a better way of saying this? You have strong conviction, a strong opinion for today, but weak conviction. You're very ready to be wrong and suddenly have this market go from bullish to bearish. So you might be right for a few hours or a day, but there's still underlying pressures. So you're trading against a current. You're flying your plane against the wind, or you're sailing your boat against the wind or against the current. And right? So you have to be sensitive to that, both in how quickly you're going to make money, but also suddenly you can go from making money but losing money a lot faster, right? Because suddenly you're being pushed to risk off again, and there's a lot of force. So anyways, realize you might be right here today for today up, which would be sell dollar, but then it could very quickly go back around this way. And then you'd very quickly, let's say tomorrow, be buying the dollar back. Now, I don't know, with this week, there's a lot going on, right? There's a lot on the calendar. Okay. And it's not just like, it's not just this stuff, and it's not just this. Now Thursday to me is the biggest day. GDP, pending home sales, Bank of Japan, and then Friday PCE, which is what the Fed watches, and then we have an upcoming Fed meeting. Like, oy vey. Okay, there's a lot going on, but besides all of this, you have earnings. Like it was Tesla. I can't remember. Somewhere I think is Amazon. I think this is Nvidia. What else is in here? Probably Google. So on and so forth, right? Are all reporting throughout the week too. So be ready for mixed. Ripper up and then collapse. Who knows? Okay. But how to make that decision? You're like, well, what if I'm risk on? Well, then what QuantBox does for you, like I said, this is like a retail trader's Bloomberg terminal. This updates in real time on the short term, and it's looking at volatility through the VIX. It's looking at gold. It's looking at the stock market. It's looking at the yen. It's looking at the dollar. It's looking at yields. And then understanding the normal correlation relative to risk on or risk off. And then scoring them together to discern, is it risk on or risk off across all these asset classes? Looking for congruency, what we call underlying intrinsic trend. Okay? On multiple time frames. And this was a -4 like on Thursday. And then since Thursday, we flipped to a -1, which is non-directional. Cray. But the odds are, okay, still down. Why? Well, month over month, VIX is up 28%, bro. Yeah, gold is up 8.5% month over month, bro. These things are horrible. S&P 500 down over 5% month over month. That's bad. There's still lots of bad here. And we know an object in motion tends to stay in motion, right? That sentiment is likely to continue. Okay. Now, Alex says, hey, sometimes I stare at the put-call ratios. I'm trying to add that to the thought process. I'd like to add it to our dashboard, but I'd also like to add it here, so we'll call that a put-call. Add that in the congruency analysis. Because we know there are situations where looking at the options market, which is different from all of these, we can see how they're positioned for risk on or risk off. And that might be helpful because here we are looking at the stock market. Here we are looking at the bond market. Okay, here's dollar and yen, so we're looking at the Forex market. We're looking at metals, but also relative to inflation. And then we're looking at volatility, which is options on the S&P 500. So this VIX has to do with options on the S&P 500, otherwise known as the fear gauge. But then if we look at the general put-call ratio, it could be yet another way to say, well, how does the option market fit? And remember, institutional, so we'll call this institution, might be long SPX, which we're tracking here, but they could use futures and they could use options to hedge. And that we could be able to track. Although I believe this is changing quite quickly. And most institutions are trading the way that I trade my pension fund and endowments, in which if you first of all, you wouldn't just be an SPX. Now you could be like Dow, SPX, and NASI, right? And what you could do is rotate around versus just simply be stuck in one and then hedge with futures or options, because futures are expensive, and if you're in a taxable account, things get complicated. But now what you're seeing, and this is what I do now, just before the big breakdown in NASDAQ, I actually sold my NASDAQ position. Oh, but then you could rotate, instead of rotate like this, which would be traditional, or use futures and options. What you do is you can put it in some ETF that has an active strategy that might allow you to, let's say, just put it in a money market. It replicates a money market, right? Or offers an option strategy on top of what would otherwise be your NASDAQ position. Or it can put you into a basket of treasuries. Okay? And I was thinking about writing a paper about how 10 years ago I said the 60-40, 60% stocks and 40% bonds is a dead model. It's dead. And it died the day the Fed started to use quantitative easing. And even right now, the Treasury market, so when we look at the 10-year and the 5-year, for example, and the 2-year, and, these curves are inverted and all that kind of stuff, and it's a real mess. But I look at it and I say, well, the Fed is not doing QE, it's doing QT. So the Fed is selling $1 trillion a year of treasuries it already owns on its balance sheet. Do you know what happens when the Fed is selling? It raises the yields, which lowers the price because you have the Fed selling. And when there's a huge seller, prices fall. So this died with the Fed killed it. So what's the new model? And by the way, that goes all the way back more than 10 years ago. But there are still sports marketing degree people that now call themselves money managers that read a book 25 years ago that said the 60-40 split is the safest thing. But they have no idea of what quantitative analysis of macroeconomic data means because they have sports marketing degrees. They don't have a finance degree. They don't have an economics degree, so they don't get it. So they'll still preach what made sense 30 years ago. So what makes sense now? Well, institutional investors, and these are guys with PhDs in finance and economics. What do? And their split will be like stocks and ETFs. ETFs, right? That offer a much better strategy than just holding bonds. Because we've gone through years now of the stock market, let's say, rising and yields rising, or stock market, just anyways, the correlation is broken down because you have the government involved more than ever. Right? The government is involved more than ever. Well, what happened to the free market? Well, that's long gone, right? Hang on, like, for example, let's see if I can pull something out. Hang on. I was going to see if I can quickly pull up the balance sheet. Fed balance sheet. Because when I try to bring it up, they're like, you want to know the FDIC balance sheet? No. Okay. Okay. So let's look at this, for example. Okay. See, I just pulled this up. Isn't this nice? Your YouTube guru actually knows how to go to the Federal Reserve into their database and generate a report in real time. How nice is that? All right, so check this out. This is the balance sheet going up. This is the balance sheet going up. Okay? Look, do you remember the great financial crisis? Check that out. We were down here at $1 trillion. And the Fed jacked it up to $2 trillion. Why? To avoid a total collapse of capitalism globally. And for some reason, our central bank and our central government decided not only was increasing the balance sheet from 1 trillion to 2 trillion, they thought, wouldn't it just be fun to jack it up to 9 trillion? Holy criminy! In that short amount of time? Jack it up? We thought this was crisis mode back here. This is ridiculous, unthinkable. Unthinkable. Absolutely, extraordinarily unthinkable. Okay? But the stock market rallied here, and the stock market rallied here. Of course, your dollar's worthless. Okay, but check this out now. What is happening at the Fed? Sell, 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 sell. They're selling. Remember, this is it's not money supply. These are bonds sitting in a bank vault at the Fed. They're little pieces of paper. Some of them are even mortgage-backed securities. And right now, they're selling them. They're in the market selling them. They're sellers. And what happens? Okay, let's do it this way. Let's go to, okay, what happens when the Fed is selling? Treasuries. There we go. What? Oh man, this worked earlier today. Now I glitched again. Man, it worked earlier today. Let's see if I can get it to reload. This one's a hard one to get the data. So the 10 years specifically is a little glitchy. It's not us, it's the data. Hopefully I can get it to display. If not, you'll have to just take my word for it. 10 year. Dang it. Anyways, boy, is there a way I can manipulate that? No, you'll have to watch the video I did earlier today on YouTube. It's uploaded to YouTube and it'll release because I had the better chart there. Yeah, I was just wondering if there was a double. So anyway, so go back and you'll see this. Here we are. And let me go here. Maybe I can pull it up. Oh, no, because it's not a recording yet. So anyways, here, watch this video, and in here I have the data and I'm trying to make a similar point today. When this is occurring, yields go up. Okay? Yields go up. And that's a concern for investors. And what I'm saying is, if yields are going up, it's not necessarily because that's how the market is reading economic conditions and investing conditions. They're going up because the Fed used to have $8,939,199,000,000 in assets on their balance sheet. And now it's $7,438,176,000,000. Okay, so we've gone from 9 to 7.5. That smells like 1.5 billion. Sorry, trillion. 1.5 trillion they've sold into the market. Now that's a lot of money, don't you think? But it's not the market, it's the government. I'm calling the Fed here the government. The government is selling that. Okay, now let's break it down. What else is going on in the world today? Okay, so you have the Fed selling treasuries, right? Let's just call it bonds, right? Okay, government bonds. Well, what about the Treasury? What are they doing? What's going on with the Treasury? Anything going on this week? Okay, well, today, April 22nd, the United States is selling 3 months, and they're selling 6 months. There's a couple other ones too. Where are they? 2 year, okay. There's a 2 year and this is Wednesday. Two-year. Okay, there's another auction there. What is that, about 5? Okay, there's at least 5 auctions this week. 2-year, for example, and what was the other one? Okay, a couple of 2-year, and there's another one somewhere in there. My point is, they're selling selling treasuries, and which is normal. But some of these issuances are the largest in history. Okay, so where do you end up? What's my point here? All right, well, let's say we have 2 arms of the government. The Fed and the Treasury. Okay, the Fed is, selling, and the Treasury is selling. And basically, the highest ever in history and the highest ever in history. Not only are they selling, they've never sold this much before. And I don't mean combined. Individually, the Fed's never sold this many assets this fast. And the Treasury has never sold this many treasuries this fast. And all of that pushes up rates. Not the Fed funds rate, but everything else. Okay? Fed funds rate goes up, but what's the value of the assets? This is why I'm like, Grandpa used to have a 60-40 portfolio, 40% bonds, and he did well. Yeah, but the value is falling on those assets because the government is destroying the value that its citizens were told would be safe. So the government is giving you free money on one hand and stabbing you in the back with the other. Oh, you can have free money, but by the way, your savings are now worthless. Would you like some more free money? Okay? They're destroying money. So why would you want more of it? So you wouldn't want a 60-40, but you could then, my other point is then institutional investors are not making those types of decisions. They should buy more bonds like they used to. But they're like, okay, there are strategies you can access, okay, that are less passive and more active, and you can just pick that up in an ETF, which is interesting. Right? So the U.S. government has decided basically, what was it, $100 billion is going to be given away to our friends. Some to the Ukraine, some to Israel, some to Taiwan. So where does that money come from? Well, you got to sell some more treasuries. Yeah. Yeah. Holy smokes. Definitely a manipulation of the market, don't you think? So that's not capitalism, by the way. Just want you to know, that's not capitalism. Okay, John Maynard Keynes said, when the economy, John Maynard Keynes said, when the economy is down, government spending should be up. And when the economy is up, the government should pay the debt down. Right? So the Fed is doing this right now. So the Fed funds rate is constant, but your mortgage is 8% or 7.5. What's the percentage on a car loan? Car loan interest rates. Who should we go to? Navy Federal, Bank of America. Is this right? I thought it'd be higher than that. 6 to 7.5. I thought it'd be a lot higher than that, actually. Maybe that's some Bank of America promotion. Average Nerd Wallet, I guess. We'll go to Nerd Wallet. When did this come out? Today. Recently. Last week. Okay. Nerd Wallet has analyzed this. Okay. Non-prime. Okay. You're not subprime, which is poor people. You're not prime, which is rich people. Okay. You're an average Joe. And this is what I expected. Okay. You see that? 14%. Now, this is an average Joe that doesn't understand money. But so they'll take a car loan at 14%, right? Wow. Now, maybe they save some money on the depreciation, but in this case, it might end up being better to get the new car, right? So, in many ways, that's what the interest rate is, right? Let's just call that 10%. Now, we look at this 30-year fixed at 8%. But I don't know anybody that owns a $300,000 house. So we call that, well, if you have more than 500,000, and they might have raised it, but it used to be 500,000. There was something called jumbo. Okay, so let's just put you in $1 million house, which is a garage in half of America. Like if you live in Boston or San Francisco, $1 million is a parking spot. So what are these rates? Let's put this in California. Okay, you live in a trailer in California. Is it the same? Jumbos, or is it just not recalculating? Really? Is it updating? Oh, well, they're about the same. I'm actually surprised by that. I thought jumbo would be a lot more. So you're still looking at, certainly ooh, there we go. What is this? 800,000 California. 8. Wow. And then down to 7. That's interesting. There's a glitch. You don't want to be too low. Yeah, look, you don't want to borrow 800,000. Holy crap, that's what I expected. 8.7, but if you bump it up to over $1 million, holy smokes, it drops. Mostly because there's probably more demand. Nobody needs an $800,000 mortgage in California because they don't exist. Right? So anyway, it's kind of interesting. So anyways, those are related very much to the Fed selling $1 trillion a year. So the Fed funds rate, the Fed funds rate has been stable, right? For a long time. What, 6 months, maybe more? But your house costs more. Your car costs more. Your credit card costs more. Those are also interest rates. Okay? Okay. Also, I want you to see that other group said this was normal. Okay, you can't even get a mortgage at 600 anymore. Okay, well, it's 720. Okay, a 30-year, $1 million loan. Well, actually, let's go back to that 800,000. Okay, so you buy $1 million house, 20% down, $800,000 loan. Okay, you see how that works? And a regular person pays 8.64. What happens if you have credit? Okay, it goes from 8.6 to or 8.7. Okay, so 0.75% difference. What does that mean over 30 years? A huge amount of money. Huge difference. Okay, loan amount, 800,000. You bought yourself $1 million house. We said this was 8.64, remember? We'll call it, well, one of them was almost 7, so we'll put 8.65. Okay, $6,000 a month. Because you're average. Sucks to be average, huh? Nobody wants to be average. Yeah. All right, so let's say this drops to 8.0. Does it matter? The same house. Remember, the exact same house. The only difference is your credit score. Okay. So we'll call that 5,900. Okay, so we're talking about $350 a month forever, right? Now, we're only going to calculate, well, how many 30 times 12? 360. Okay, payments times $333 a month because you have less credit score than me. So I immediately save $120,000. Now, that's not the right answer, right? Because there's two things. There's time value of money, but I could take the extra 333 and pay down my loan faster. You see? Or the other way to do it, oh, it's not going to let me. I can buy a nicer house than you because I can afford, let's say, I'm going to pay $6,237 a month. You're going to pay $6,237 a month, but I'll get a house that's 500 square feet bigger. Or I'll live in a neighborhood that's better. Or I'll live closer to work. Pay the same amount of money as you because I can afford it because of the difference of that. It's real. Okay, so there's like, based on credit score, changing your interest rate, right? What if, and this is what I'm trying to say, okay, you're stuck here, right? Let me write this down before it changes. So where's my little, okay. Of course it went away. 6,327 was it? Uh, 237. Let's get it right. Oops. 237. Come on, 237. Okay. Let's say the government wasn't screwing around with our treasury market. Remember, they have 700% more treasuries on the balance sheet at the Fed than they did before the 2008 financial crisis. 700%. It's significant. And The government, the Treasury, is selling more treasuries in the history of the Treasury. Okay, so it's a big deal, right? You want to see this? Are you ready? I have a mortgage based on, let's say, a slightly better decision before the Fed really went ape crazy. Okay? Mine was back in 2000, or a while ago, right? Okay? So before the craziness that we have. And I'm trying to show you the real impact on lives of citizenry based on the actions of the government. Most of these actions had to do with giving money away for free to quote unquote help people. But now we have 8.65% mortgages. You know what mine is? Okay. Same house as you. I pay $3,373. You pay $6,237. So that extra $3,000 a month, I save and invest. So right off the bat, you're going to think, okay, think about this, $3,000 a month. Let's go back to our calculator. Okay, $3,000 a month times 360 months over 30 years. Okay, I just made $1 million. And you have nothing. But that $3,000, see, this is what you've paid to the bank in interest. I just didn't pay it in interest. So I save it, right? So I just made you don't have $1 million in cash. I have $1 million in cash. But I also invest it. So now you're like, wait. Okay. So you have to do $3,000 a month times 12. Okay. 36,000 compounding at 10% a year. Okay? Which means in 10 years, this will double. It's actually 7 years. But anyways, let's say in every 10 years, this doubles. Okay? So in 10 years, in year one, I have 72,000. Remember, you don't have anything. This is based on the money I saved in 1 year. But then another 10 years goes by and it doubles again. This is money you don't have because the government screwed you because they gave you free money. That's you saving $36,000 for 1 year and compounding at 10% for 30 years. Now, of course, this is very rough math, back of the tablecloth kind of stuff. But what I'm trying to say is the government gave everybody in America, almost everybody in America, about $10,000 for a family of 4. And everyone that got it is worse off. There's a shortage of housing. Houses are too expensive. There's a shortage of right? Right? So how do we say? There's a shortage of housing because there's a shortage of workers to build houses. So therefore, houses are expensive. Let's solve that problem because high prices of real estate affects everybody. The entire housing market, right? So wouldn't it have been better to say we need an extra 100,000 construction workers. So the government's going to design an education program that's going to be free for anyone who graduates the program. And the immediate reward will be a job. And America is going to double the amount of housing that they build every year. And when you double production, cost per unit, so the price of every house in America, a new home, because remember, they're all new homes, they'll either be 30% more affordable, or they'll be 30% bigger, or 30% nicer somehow. Because we have the production going up. But now what will happen is, it's not that people are building affordable housing, it's that houses are affordable. I think it's a crime for somebody 75 who bought the house for $60,000 is now selling it to a 25-year-old for $101,500,000. I think that's a crime. But the thing is, there's no new houses. And if you want to live in the Silicon Valley, I'm telling you, $3 million doesn't buy you much. You're like, $3 million? I lived in the Silicon Valley for 15 years. And I like to talk to everybody. So I've talked to tons of people that were moved to the Silicon Valley before it was the Silicon Valley. They moved there for defense jobs. And then later it became software. And then later it became hardware. And then later it became the internet. And now it's AI, right? I mean, I lived in the Silicon Valley when they actually built chips there. They actually built semiconductors. And then the world changed, and it's all in Taiwan, and now the world's changed again, and now it's coming back. But the thing is, I met tons of people that bought these houses for 20 grand, and they're selling them for 4 million. Well, that's a crime. Why? Well, there's not enough houses. Why? We don't have enough workers. There's a shortage of workers. How do I know? Well, let's go back to the Keynes. The Fed, let's say the government, should be paying down debt. They shouldn't be borrowing more. They should be paying down debt because times are good. Are they? Prices are high. Well, why? Because maybe we still have a supply issue. There's no workers. If we had more workers, we'd have more houses. We'd have more everything. Okay? JP says, yeah, $3,000 a month for 30 years. Compounding, yeah, totally right. 6 mil. Here was going back to that, Jim. This is my point. This is how the rich get rich and the poor are kept poor. But the difference of someone with mediocre credit and great credit in this situation has very much to do with the government's actions. And it's not that I get such a better rate. Well, I bought at a time when government action was only grossly negligent. And now it's at some plane of reality that is unbelievable. When 1 trillion was unthinkable, how could 9 trillion 10 years later be even conceivable? But here's the other point I'm trying to make. There is a real world consequence. We have massive inflation because we did something so ridiculous. And, well, some will argue that, well, it benefited those that needed the help. And now one person like myself will be in a position of many millions of dollars better than someone else in a similar situation today as I was 10 years ago. but they will not have the millions. They will be broke when they die, and I'll have too much money to spend when I die. And the difference was I made the decisions before the government screwed me over. That's how I look at it. I know that's pretty harsh, but I'm like, there's a real consequence. And rates are going to continue to stay high, maybe not the Fed funds rate. So that's sort of like a PR program. They'll say, oh, well, let's say 1 or 2 years from now, they'll say, oh, well, the Fed funds rate is only 3.5. Yeah, well, what if your mortgage is still not 3.5? What if your mortgage is still 6? What if your credit card is still 22? What if your car payments, maybe they're not 9, but what if they're 6.5%? Well, then someone with a better credit will get a better deal, or even better, because look at all the money I'm saving, right, Jim? If two comparable people, I live in the same house as you, we're neighbors. I bought my house 10 years before you bought your house. You pay $3,000 a month more for the exact same house. We're neighbors. So, right? So my neighbor is driving a used Hyundai Sonata with 150,000 miles on it. And I'm driving around a brand new Porsche, and I still have $1,500 a month more. So I'm like, well, what am I going to do with the other $1,500? I don't know. I'll buy a giant TV, but that only gets me through 1 month, and then I'll still have $1,500 too much money compared to my neighbor. Like, all of a sudden, it's a grossly amount difference. Okay? All of a sudden, I'm going on fancy vacations. I'm Instagramming my whole life, and it's crazy. Right? Every weekend I'm drinking Dom Perignon, but I can't spend the money. That's a lot of bottles of Dom Perignon. Dom Perignon's only $250 a bottle. And my neighbor is counting pennies. You see the difference? We live in the same house. We're neighbors. It matters, doesn't it? So, but again, what happened? Well, you can look at it this way. I have strong dollars, and my neighbor has weak dollars because the government printed so much money. Now, it's really not printing, it's borrowing. The government has borrowed so much money that my neighbor who moved in next door to me last year has money that's nearly worthless, and my money is like bars of gold. One guy is filthy, stinking rich. The other one is barely scraping by, and the difference is government policy. It's not the house. It's not the neighborhood. All of that is fixed. Isn't it amazing, though? And here's another thing. If you've known me for, let's say, 10 years, you've been logging in, and we've been having our conversations for the last 10 years. There was a time, it was after COVID, I believe, like maybe even a year after COVID, but there was a point in time where I said, it's all about to change. And I gave the advice to everybody to borrow as much money as you possibly can and buy a huge asset. I looked at a 12,000 square foot house. I think somebody else bought land, but they went out and borrowed the biggest amount of money they could purchase. Because I said, you'll never see money this cheap again, ever. Ever. It'll never be this cheap again in your lifetime. And you got to get as much of it as you can because rates are going to skyrocket. And they went from like 2.5, 2 3/4, or even 3, depending on where you were in your credit history and all that kind of stuff. But let's say about 3%, and they went to 10%. More, a minimum of 300% increase in cost. And they're still not far off of that. Pretty amazing, right? Yeah. So it's only money, everybody. The cool thing is you can learn money. Okay? Money is easy. Money is math. Okay? Yep. So like JP says, hey, compounding is important, right? So Jim, my son saves $500 a month from his job. He's a teenager. $500, $6,000 a year, but it's going to compound for 50 years. So every year, bare minimum, my son will have $50,000 a year when he retires from his, job. Right? Not much more than minimum wage. Saving only $500 a month. It's $50,000 to $60,000 for $500 a month. It's incredible, isn't it? Then I told him, and it's a retirement account, by the way. So I'm like, okay, that's your Roth IRA. He maxes out his Roth IRA. So I'm like, okay, but look, after college, you're going to get a good job, and they're going to have a 401k. So you're going to, hopefully he goes to a good university with an engineering degree. We just toured Georgia Tech, and they said, look, your first job on day one, you're going to earn about $120,000 to $150,000 a year. That's what Georgia Tech students do. With the undergrad, and they say you will graduate with a job, and it will be $150,000 a year. Okay, so imagine now you have a 401k, and there's some employer matching, all that kind of stuff. So if he maxes all that out, and then with his Roth IRA, when he's ready to buy an apartment after graduation or maybe after grad school, he wants to buy an apartment, he can withdraw money from his Roth account, which is now grown, and he can use that for the down payment on his apartment. And if he gets a 3-bedroom apartment, he can rent the other 2 out, and they pay down his mortgage. Meanwhile, it's all deferred taxes. I mean, so I'm showing my son, everything I'm teaching you. I said, son, when you're my age, you're going to have $25 million in cash. Well, in retirement accounts. From this, just not from because dad is generous and dad was rich or something. I'm teaching my son about money, and it's simple math. And knowing how to play the game. And deferring your pleasure. He could spend $500 on crap and then retire poor. But he's not. He takes half of his money and saves it, and the other half, well, he decides what to do with that. Math and patience. Well, it's really knowledge. I don't even think it's patience. If you just knew, then it would make a difference, right? So both my children are teenagers. Both of them have retirement accounts that are contributing. So parents, listen to this. When your kids become teenagers, they get a job. They have to have a job. Then you get them to set up a 401k. Their 401k, in this case, it's called a Roth IRA. They don't pay taxes on any of the investments until they retire. Okay, great. Now you can kind of sneak it, parents. You just put $50 of your money in there. Well, you don't get a tax write-off. You already paid taxes on your income. So there's no benefit to you except being the world's greatest parent. So they're 16. They got a job at the pet store or something, right? They're working at the pizza joint. Okay, as long as you get a paycheck, right? Open up a Roth IRA, and parents, you put in $50 a month until you die. $50 a month. You probably spend more than that at Starbucks. $50 a month. So when they retire, how much is the $50 a month worth? Remember, we're talking about changing your lineage, your bloodline, the path of your lineage of maybe being stuck in middle class or worse off for forever, right? If you're middle class now, your parents were probably middle class. And your kids are going to be middle class, and their kids are going to be middle class. Okay? How do you break the poverty trap? How do you get to the next level and change your bloodline, not your bloodline, but the path of your bloodline? How do you get from poor to rich to wealthy? Remember the book, I Still Want to Write This. Do you know what the $50 a month adds up to? Don't Google it, just guess. When you put in $50 a month into your teenager's Roth IRA, how much are you giving them? Type in a question mark. If you don't even have a guess, type in a question mark. Don't Google it. Don't do the math. I'm going to give you a rough number, but the point, it's accurate to make the point. It might be more, and it wouldn't be much less than I'm about to tell you. Now, some of you might know because I've given the speech a few times. But I'm just telling you how easy money is. It's not easy money. It's understanding how money works. No one else wants to guess? We have 2 guesses? What is everybody else doing? Am I on the wrong topic? Okay, you want to just go back on... I covered this trade that's working out right now. I already covered it like 3 hours ago. So, okay, nobody cares. So I'm going to answer it and I'm going to move on. $1 million. Okay, minimum. You just gave your child $1 million when they're ready to retire. The worst case scenario, if they save nothing themselves, they never get a good career, they never start their own 401k, they never own their own home, they don't have all these things of like that make you wealthy. Okay? If all they had, so they're deadbeat loser children. Sorry. Well, at least they have the $50 a month that you gave to them in their Roth IRA, and that will be worth a minimum of $1 million. But yeah, it's starting at a teenager. Yeah, so when they're teenagers and they got some silly, a minimum wage type job, they're still earning income. They're still, can file for taxes even if the taxes are like nearly zero because they don't earn very much. But you can put $50 a month into the account for them. If you put in $100, it's not like it'll be $2 million. It'll be more like $2.5 million. But you have to be careful because it's if they earn $200 a month, you can't put $500 in tax deferred, right? They have to earn income. That's what I'm trying to say. But $50 you could do, and that'll be worth $1 million by the time they retire. So you just have to contribute $50 per month every month for years and years and years and decades. But Mom, Dad, you can do that, right? $50, even if you don't have a lot of money. Even Jim Cramer talks about when he was homeless before getting a job at Goldman Sachs, when he was sleeping in a car. He chose, well, he could put the money toward housing, or he could put the money in his in a mutual fund, I think is what he said. And he chose to invest the money. So all you have to do is understand money and then have the right strategies around that and playing the game. And America's all about playing the game. This is about a game. Remember Trump? He said, he's like, the game's rigged. I play the game because that's how the game's been designed, right? And that was truth. Even if you hate Trump, that is the truth. So anyways, America got free money. And it's one of the worst things to have ever happened to America. Okay? Everybody is worse off. If the government had said, okay, 10% of America has lost its job, so we're going to do some special program for them, versus we don't want to discriminate against anybody, so we'll just give everybody money. That's dumb. And now everybody pays the price. Everybody is worse off, except whom? The rich. When you pay rent, it goes to a landlord. When you eat at Applebee's, it goes to an owner. Okay, when you shop on Amazon.com with your free money, you make the seller of the product wealthy, but you'll also make Amazon.com wealthy. And those who own the companies, those who own the stocks, those who own the real estate, those who own the banks, they get richer and richer and richer and richer and richer because all that money that was borrowed gets pumped into the economy. Most people spend the money, so consumption goes up, but then all the money goes to people who own, and they don't spend it. They invest it, and it just gets locked up, and suddenly you're like Jeff Bezos making $1 billion a month when 10% of America was unemployed and getting free government assistance. And the outcome of that, Jeff Bezos making $1 billion a month, month after month after month. So the poorest got the help and the richest got richer. How about that? So here's the thing. If you want to become wealthy, you need to own assets. And the government will always take care of you. Even when they think they're doing either rich people harm or poor people help, when you borrow and spend without consequence, the only thing you're going to do is make the richer richer and the poor poorer. And it creates the income inequality you're trying to prevent. So Democrats will, and this is political, but it's also economic. When Democrats say income inequality is bad, they believe it. And I believe it. It is bad. I have no problem with that. Income inequality is bad. But when the Democrats say, okay, income inequality is bad, so we'll raise taxes on the rich and then we'll give it to the poor, like Robin Hood, sounds really good, but you know what you end up doing? Making the rich richer again. The unintended consequence is usually quite negative. So, why don't you get on the side of you should choose wealthy. Choose to be rich. Right, Pavel? Choose to be rich. In this case, don't spend your money, invest your money. Okay, like I said, $50 a month when you're 16 turns into $1 million. Well, by the time you're 26, you should be saving $3,000 a month, which is $2 million. Well, actually, no. Over less amount of time is $2 million. And by the time you're 50, you should be saving $5,000 or $6,000 a month, which is another $2 million. Plus, you should pay down your mortgage so you don't owe a bank any money for your house. You own it. Well, what does that mean? Well, it'll go up 300% by the time you sell it and buy something smaller. Meanwhile, you got your corporate 401k. So, like, if you just start and you keep doing it, how does the game work out? When you're old, you'll just have too much money. And you're like, well, Wayne, that sounds funny. No. That's what definition of wealthy is. There's tons of people that when you see their spending habits, they have excess. Okay? So, for example, let's say you had $5 million on the day you retired, but you own your own home, so your expenses are quite low, right? And you're producing 10% income. Okay, great. So now you have to struggle to live on $500,000 a year. Do you see my point? $500,000 a year. So you have to go $500K. Okay? But you have to pay taxes, right? Okay? So, right? So now you earn $333,000 after taxes. Let's divide that per month. So now you have to figure out a way, when you're too old to work, to live on $27,500 a month. Okay? But you're like, but that's extraordinary, Wayne. That's way beyond what I make now. Well, if you had started as a teenager and carried out these basic philosophies, or it's better than philosophy, but we'll say philosophy. If you stay with the tried and true and proven philosophy of understanding how money works, and you only did a half-assed job of it, starting young and carrying that out through your life, that is achievable, or something close to it. Maybe it only ends up being $17,500 a month. Okay? Because it depends on where you live and your income level and all that kind of stuff, right? And your education level. So let's say you just you don't quite get, but I understand what it's like. I grew up poor. I didn't grow up with money education. Yeah. So I understand where you're like, well, and that's why it's called a poverty trap. You don't know anybody that makes money. You don't know anybody that saves money. You don't know anybody that owns their own home. You don't know anybody with a college degree. You can't get mentorship. There's all distractions all over you. Drugs and crime and this and that. You don't have a parent that takes you to the science fair. You understand? Like, it's just because your parents work. I grew up kind of in that environment. Okay? I took myself to my own soccer games as a 10-year-old. I didn't have mom and dad put me in a fancy minivan and stop at Starbucks and drop $30 on a quick breakfast and a couple of lattes, and they sit there in their designer clothes and their designer chairs watching me run around, right? Go away, go! Go, go, go! I didn't grow up in a world like that. No, my children did. So, right? So I get it, but once you know, you should then break out of the poverty trap, even if you're only saving $50 a month. I want you to say it adds up to a huge change, not only in your life, but the life of your children, your grandchildren, and your great-grandchildren, if you simply teach them. Somebody has to break the chain, break out of the trap. Okay? So, Roderick, is it too late at 40? It's only time and money. Okay? Get a second job like trading Forex and save it. Okay? Okay, like for example, okay, Joe is A and Jenny is B. Joe opens up an account, a Forex account, $5,000, and trades. Okay? And pays taxes. Okay? Jenny puts $5,000 in a Roth and trades. Oops. And no taxes until she retires. Who's going to have more money at the end of the time? Jenny, okay, makes, I forget the first guy's name. They both make the same amount of money. Jenny is going to retire way ahead. And the only thing they did different was open their Forex trading account like a boss. What does that mean? With a retirement account, like a pension, like an institution. Okay? But Jim, I'm just saying, like, they both decide, oh, I want to trade some Forex. Okay? Trader A doesn't really get it. Okay? Trader B is money educated. And I would suspect most of you guys are A. Oh, I'll pop $5,000 into an account and I'll probably blow it up and then I'll go try some crypto. No offense, that's what most retail traders are like. Someone else takes it seriously and trades it like a small business and they understand money. Okay? And then when that's profitable and they max that out, Trader B then, right, has a track record of success, knows how to trade, and then Trader B then, so Jenny then incorporates. Okay, are you ready? Sells some property, sells some assets, maybe sells her house, comes up with some money, some inheritance, whatever. Okay, and puts $500,000 into an account. But an incorporated institutional account. Okay? And from that, Jenny makes, I'll make her a good trader. She makes $250K a year. Of which, you following me here? Okay. Puts in $60,000 a year into her simple employee pension, which she gets to trade. See, she has a Roth, which she gets to trade. Then she opens up a SEP, okay, which is also deferred taxes, and she gets to trade that, okay, and doesn't pay taxes now. Okay, so maybe you're there, right, Roderick? Maybe you can do something more like this. And so combined, Jenny is saving $65,000 a year pre-tax, right? Like you'll pay tax later, but then you compound 65 grand a year. Okay, I had a question, is it too late at 40? Okay, well, let's take a look. Do I still have a... 40,000. Okay, I just want to put it out there so everybody, I know the math. Come on. Times 20 years. Okay, let's put that there. Okay, so you've saved $800,000. No. You didn't pay taxes with this money. All you did was, instead of paying taxes, you got to save this $800,000 as if you never earned it. And now over that period, you have the $800,000 to trade. You see? So you have to go back. By the way, I put 40,000. My God, it was 65,000, wasn't it? Sorry, clear. 65,000. Okay, times 20 years. Sorry, my bad. Okay, 1.3 million. That all you did was not pay taxes on. And you get to trade it. So you know you're compounding. So you have to go back. Okay, you have to go back, all clear. 65,000 in your first year. Okay, in the second year you made 10% on that. So it goes back to your first year, 65,000 plus 6,500. Okay? And you're like, that's not a dramatic change. Does anybody have a compounding calculator? What's 65,000 a year compounding at 10% for 20 years? It's actually 25. If you're 40, is it too late? Well, you're retiring at 65. You can keep this up until about 72. But let's say 25 years. Does anybody have a compounding calculator? I thought maybe Jim would. 65K, 10%, 25 years. Okay? It's more than 2 million. Nobody has it? It's almost done. Hang on. Oh, ChatGPT. So I asked ChatGPT, it did the present value. I didn't want the present value. So I said, what is $65,000 invested per year, compounding at 10% per year, each year for 25 years? Maybe it's the each year. But then it did the future value. Okay. The future value is equal to the payment times 1 plus, right, R over N to the period. Okay, so it depends on the interest rate and all this kind of stuff, which is your discount rate. And that's not really what I asked it. Okay, because the total number is going to be significantly higher than this, but in today's money is what it's saying. Okay, that's not really what I asked it for. But, yeah. No, that's future value. I want the absolute value. Because that's discounting for inflation and, I mean, that's the discount, okay? I don't want discounted cash flows of that. I could probably say do not discount. I wonder if it'll update and give me what I want. I think it's gonna. I think it's doing it now. We'll see what it comes out with. There we go. 1,625,000. So if you're, wait, that's not right either, right? Even that's not right. See, you got to know. Because if you go 65,000 times 25 years, yeah, that's not right. It's not compounding at all. Once again, that's not right. That's just 65,000 times 25. That's no. Stupid AI. See, you still have to hire a finance person. Whatever. All you have to do is pull up a calculator. I don't have time for that. We're approaching 10 o'clock. I got to go because I want to watch the stock market. Let's see how our open was. Okay. Okay. Okay, so we're climbing back into the zones, and that's what I'm worried about, huh? Oh, I don't know, Chris. You probably have to contact them. So as ChatGPT, a simpler version, it's still doing the same thing. It's trying to calculate the future value, and I'm not asking it that. I'm trying to do the compounded value. Maybe I can say it that way. What is the compounding absolute value of $65,000 saved per year, earning 10%. Let's see if I just change my language quite a bit. The future value of an annuity, that's not really what I'm asking. Again, yeah, it's not answering the question directly, so I must not be answering it correctly. But anyway, so right now we see there's a little up pressure, but we know where that 21 is. So I'm still interested in selling this. And, much of these assets are the same. Grumpy Cat. Yeah, that sounds actually a bit high, but over 25 years versus 20. Okay, yeah. Grumpy's like 4 million. Yeah, 375,000. Yeah, that's higher than I thought, but definitely not this 1.4 or something, because that's just barely the amount of money you actually saved. Because remember, your initial 65,000 earns 6,500 the first year. Then it earns, let's say, 6,500 the second year. And then it earns 6,500 the third year. The same 65,000 keeps earning. Okay, and then plus the 65,000 you saved in the second year. Now it will earn 6,500 every year for 19 years. And then you save another 65,000. And it will earn 6,500 for 18 years. Plus the other one for 19 years, and the other one, but that's kind of that logic, right? Yeah. Okay, so ChatGPT gave me a different answer on this one than yours. But again, it's the model and the interest rate and the inflation level in each model. I don't know what yours used. But it said, okay, to find the future value of an annuity compounded annually over 25 years, we can use the formula. Okay, annuity is equal price times 1 plus r to the n minus 1 over r, where r is the annual rate of interest. Okay, n is the number of periods, 1 over r to the n. Okay, so on and so forth. So 65, right? 65,000 a year, compounding at 10% a year over 25 years. You plug it in. Okay, so your annuity grows to $5,400,000. So the future value of saving $65,000 per year at an interest rate of 10% per year, compounded annually over 25 years, would be approximately $5.5 million. Okay, so who said it? Somebody asked me, is it too late? Yeah, Roderick says, is it too late if you're 40? Well, you're like, but Wayne, that's ridiculous. I can't save $65,000 a year. Well, that's if you're earning $250,000 a year on your Forex account. Yeah. Okay. So it all depends. Or flipping houses, you can earn that. Or whatever your side hustle is. whenever your side hustle is, whatever it is, get yourself incorporated and making $250,000 a year. You can open up a pension fund, and your corporation funds it on your behalf. Okay? So you have to know how to play the game. I play this game. That's happening for me. Okay? It's only math. It's just a game. Quick look at commodities. Can I look at sterling? I mean sterling silver or pound sterling? What? Sterling? Yeah, so I'm watching support on that monthly central. So I'll come back to that. So today is an observation day really for me. That's why I'm not spending that much time. Okay, gold collapsed. Yeah, okay. Well, we have to note that, and we'll note it this way. Okay, could be a change in behavior. Hua? Maybe we'll do it this way. Okay, plausibly, I'll put it this way. Plausibly, a breakout. Okay, very interesting. Still short the S&P 500, gold coming down. I guess I should look at silver just quickly and see if it's correlating. And yeah, silver's coming down. Am I out? Looks like I'm out. Looks like I got knocked out on my silver trade. This is actually interesting for buying. I might buy it back today. Ooh la la. So here's how the wane do. I would mark this. And that's my bazone. And I go to a 5er. Oh, golly, Batman. That looks hot to go. HOTTOGO. Oh, hot to go. So I might be interested in playing the game here. Oh, yeah. That might be interesting. Cool. A request about the pig. Well, before I even look, well, look at this. Okay, so what do you want? Pound sterling down, right? I don't know. I don't know if it can fall any farther today. It's a dog with fleas. We looked at the COT. I mean, maybe I can do that. Well, you know what? I'll leave you with this. I cover this in where did all the YouTube stuff go? Maybe I'm on a different page. Is it this one? Yeah, go here. Watch this video. It starts in 22 minutes, and I cover the Commitment of Traders report and some very interesting changes week over week that you should know if you're going to be a professional trader. And one of the questions today that I answer, but pound is also interesting, just so since you asked about pound. Should you buy or sell CAD? And how to decide with quantitative analysis and scientific methodology. Yeah, worth your time and worth the price of free. Okay? All right, so go watch it.